All right. We are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, whatever day it is for you, and wherever you are. As always on the podcast, it is Friday, so we're bringing that Friday energy to you. And like per the usual here in Seattle, we got the clouds back, but we did have sun for a little bit there, and everybody was happy. There was dancing in the streets, and I hope that comes back. It's a good day for a second reason, though, because we have Matt Buchalski with us on the podcast from Deep Blue Capital. Matt is a multifamily guy, and so I'm sure he has a lot of wisdom to impart to us. He got started in real estate back in 2016. Great time to get started, I'll tell you that much. So almost a decade of experience so far. Matt, I'm excited to jump into this. Thanks for hopping on the podcast.
Thanks for having me, Gabe. I'm looking forward to this.
Absolutely. I told you before we got on here, we always like to start with stories. We like to hear how people got to where they are. So why don't you take us back to the beginning of your story in real estate and tell us how you got here?
Awesome. Will do. I used to live in New York. I've been down here in North Dallas now for almost 11 years now. And I used to put together these tuna trips in New York, and I get a good core group of guys together. We go fishing. And one year, I found out that one of the guys on the trip owned 50 single family homes out in the East End of Long Island. And I sat down on a trip once and drank too many beers and asked him how he got started and what he does. And he like literally took hours on the trip and just explained everything to me. And at the end of the trip, he said, listen, if you're interested in buying stuff, he always used to call it stuff. He's like, if you're interested in buying stuff, I know a guy with some stuff right now. I'll introduce you. I said, sure, let's do it. A couple of days later, I got a call from one of his agents. We kicked it, and he told me, where to look and what his kind of buy box looked like. And he said, I'll start keeping an eye out for you. And I said, do it. And 3 months later, he called me, he had a deal, and I bought it. And that was just, the first domino that fell. 90 days after that, I bought one here in Garland, Texas. And it's been just kind of this steady snowball since then. But I'm super thankful to Pete for getting me started. I still think he's a guy that changed my life. He's not doing well lately health-wise, so my prayers are with him. But man, Pete changed my life, just that one conversation.
It is amazing how just the most random, one-off kind of conversations can completely change the trajectory of your life. And I feel like, especially in real estate, people, they just like talking about it. So if you're into real estate, you like talking about real estate. And so if you meet somebody who's kind of interested in it, they'll start talking your ear off. It sounds like Pete gave you a good introduction for multiple hours of conversation there. So love to hear that. Sorry to hear Pete's in a rough shape, but it's awesome that he was able to give to you his experience in real estate and kind of got the dominoes falling, as you said. So from those first couple of single family deals that you got, it sounds like since then you've been focused on multifamily. It looks like you also got into the Jake and Gino multifamily investor group. We've had Gino on the podcast here. We really like talking to him. So how has the transition from single family to multifamily been? Kind of take us through that period of your life.
Yeah, it was, believe it or not, it only took me like 8 or 9 months. It seemed like a really long time. So I bought that single family in New York. I put a Section 8 tenant in there. I bought another single family in Garland, put a Section 8 tenant in there. And so why is that important? Because to me, it was less work, less risk, right? I wasn't chasing down rent checks. The rent payments were guaranteed, et cetera. And to me, that's a lot of the psychological burden, especially as I start, as I manage a W-2. So shortly after that, I had gotten talking with one of the other dads in the daycare that my kids were in. And we started to get close. We had lunch a couple times. And then this guy, Mike, he says, if you ever find a deal, let me know. And I saw this 8 unit in Arlington, Texas, like a mile west of AT&T Stadium. And I threw a blind offer on it, got declined. 6 weeks later, the agent calls me back. Hey, the buyer dropped out. Do you want this thing? And I had made a blind offer on it the first time, so I never even went out to look at it. And when she called me back, I went to go drive it out there, and I took a look at it, and I'm like, you know what? If I was going to turn this thing, it was a heavy value add. I was going to spend every dollar I had on it. And that just to me didn't make any sense. And right around that same time, I was listening to an episode of Bigger Pockets, and Brandon Turner said 50% of a deal is better than 100% of no deal. So I called Mike and I was like, hey, dude, guess what? I have a deal. And so we sat down, we crunched numbers for like 2 weeks until midnight every night, and we bought it. And from that point on, that deal was we cut our teeth on it. We cut our teeth hard on it. It was, we took over the 8 unit. The day we bought it, the day we closed, there was an eviction. One unit had a hoarder. The third unit was like the cousin of the owner who was like the on-site property manager, and he decided to leave. So like our first week, we had 75% occupancy and we knew we had to get the hoarder out. So it was like, oh my goodness. But when we were done with that turn, and it took us 6 or 7 months, we realized $400 rent premiums. Um, then it was just kind of on cruise control, and we self-managed that thing for 3.5 years. I was the rent guy, and Mike was kind of the legal and finance guy, and, we just figured out how to divide and conquer on it, and we're like, it's not easy, but it was simple and we managed our time effectively. And from that point on, we tried a flip or two here or there. It just was too time consuming, too cumbersome, and we didn't make enough money to really justify the time investment. And so multifamily has been the vehicle of choice. And since that deal, I think we've done 7 or 8 additional multifamily transactions.
Nice, man. I love it. I was laughing in the background because you mentioned, your first deal, you had a hoarder, you had people you needed to evict, your property manager was living on site, and it reminded me my first deal was a triplex, and we had a hoarder, we had a guy growing weed out of
Oh,
his unit, we had all that fun stuff. But having running into issues in your first deal, I feel like so long as you do make money on it, I feel like that's the way to go, because then you realize your eyes are kind of wide open. You're like, this is not going to be easy. I do have to work for this money. Um, yeah, so that that kind of made me laugh. And I like how you mentioned that quote from Brandon Turner: the 50% of a deal is better than zero, or what do you say?
100%
50%.
of the deal.
Yeah, there you go. There you go. Yeah, and that's completely. I love that sentiment. It's also makes it a lot more fun when you have partners. I've done deals, plenty of deals myself, and I wasn't nearly as engaged or as happy in the deal than when I have partners. So I like that you brought in a partner to close that one down. It sounds like since then you've gone to 8 additional multifamily. Tell us about your criteria. How has it evolved over the time, and how has your approach to multifamily changed since you completed that first 8 unit?
That's a great question. And, I just hosted a panel on this topic yesterday at a conference in Dallas. Late 20 teens, if you will, we were all about C class value add, right? Give us the ugly stuff with under market rents. And we were going to come in there and turn the inside, fix up the outside, turn the inside, and raise the rents. And so we did that in 2017. We did it in 2018. We bought 2 deals. We bought a deal in 2020 that was smaller, 4 units. It was pretty stable. And then we did 2 value add deals inside of 90 days in Q4 of 2021. Same playbook, right? 1960s build, under market rents, mom and pop seller. We get in there, it's 34 units combined. We bought the 16 unit first, and then a wholesaler called us like 3 weeks later, seeing that we were the owner of the 16 unit, and they sold us the 18 unit right next door. So it was interesting how word traveled fast. And so in that 34 unit complex, we invested almost $1 million in capex between interior and exterior upgrades. Then in 2022, we did another 8 unit, um, off market, direct to seller, and we put like 200 grand in capex into that one. And this was all at a time when rents were increasing, right? So I think that's really important retrospectively. And one of the reasons why we've kind of changed our investment thesis now is because it's much easier to do value add deals in an environment where rents are increasing. Right now in Dallas, rents are stagnant at best, and I wouldn't do those types of deals now because you're not going to grab onto some upside. So we've really changed our thesis from C class value add, heavy lift type projects from 21, 22, and even into 2023 into more stable, less old property. So we bought a 2000s build in 2023. And then last year we bought a 1980s build that was, stable and just needed some basic unit turns. We're really, kind of riding this wave on flight to quality lately. Um, I think the returns are just more stable and more reliable despite all this incoming supply. And on the kind of workforce housing front, I think the residents in those communities are definitely feeling the economic pinch more so than any other demographic. On top of that, you ask any C-class operator out there, and we've all felt it, this rise of fraud and fake IDs and TikTok telling people where to get fake social security numbers from and all that stuff. You get one or two of those folks in your portfolio, and you're talking 10, 15 grand in bad debt and write-downs, and we absolutely have been hit by that. So we just think that, going to a newer asset in nicer areas is the move for us right now. The challenge though, Gabe, and this is something that's very, very practical, is there was a lot of construction in the 60s, 70s, and 80s, right? Then you get the S&L crisis, and there was no building in 1990s. You can't find, I'm sure there's some, but very few properties that are like 1990s vintage in Dallas,
Hmm.
right? And then all of a sudden, 2000s come around, liquidity picks up again, and now institutions are building these two, three, 400 unit communities, which are great. But when you're used to fundraising for
Mm.
$4 or $5 million deal in the 70s and 80s vintage, and now you're talking about a 20 to $25 million purchase, and with 65 or 70% LTV, the way agency is doing right now, you could be staring down the battle of an $8 or $10 million raise.
Yeah.
And so we've been very cautious in making the jump. We don't want to get too far out over our skis from a fundraise perspective. We're very proud to say that we've closed every deal that we've ever signed a PSA on. So we're being very selective from a vintage perspective, but we're also like looking through it through a lens of caution that we don't want to get too far out over our skis and make sure that we're able to raise the capital for our next deal.
Interesting. Okay. So that makes a lot of sense. Is that I mean, you mentioned there was a lot of construction in the 60s, 70s, 80s, and then 90s there was nothing, and then 2000s it started to pick up, but it was a lot bigger communities. Did that same um trend play out in other communities? Are you guys only looking in Dallas, or have you looked elsewhere? Cuz I know, people are still buying in, 90s small communities in other areas.
Yeah. So we own in Arlington, which is Tarrant County, still part of DFW, but more on the west side, closer to Fort Worth. We own in Garland, which is just northeast of Dallas, and we own in Richardson. We also own in Waco, Texas, down kind of in central Texas, and we also have a community out in Jacksonville in East Texas. So most of the stuff that we look at is within an hour of Dallas, right?
Mm.
I want to be able to either go see a deal on my lunch break, or on weekends I have the kids, right? Like go see the property, do what I got to do there, and be back by lunchtime. Like that to me is like non-negotiable. Are there smaller assets? Absolutely. However, again, as a result of our learnings from buying a bunch of smaller deals, 16, 18, 24, 32 unit deals, we realize that there's a lot of efficiency to be gained with having on-site property management teams and an on-site leasing office. Right now in our Arlington communities, we have four inside of a 3 mile radius, but we're really running a centralized leasing strategy with our PM who's not based in Arlington,
Mm.
right? So they kind of got to go out of their way, and they need to schedule tours on certain days because they got to be in Dallas, they got to be here, they got to be there. And so they only do tours for us on a couple days. So as part of our learning and part of our evolution, we're going to stop, get the handcuffs off of our operational execution plans, buy larger assets, 70 units and up with on-site leasing offices. But having made that conscious decision, it also limits the types of assets that we're looking for. And going back to what I said before about kind of the building strategy after 2000s, more 2000s and newer builds are multi-hundred units as opposed to 70, 80, 90 units.
That makes a lot of sense. Um, yeah, so we buy mobile home parks and RV parks, and we a lot of times with those type of assets, there will be the owners, they own them completely outright. And so we're able to negotiate pretty favorable seller finance terms. I know that multifamily is not quite the same. It virtually always has debt on it.
Yeah.
How are you guys financing these? Have you been able to negotiate seller financing, or is it all through just regular bank debt?
Great question. So we have done a seller finance deal. We bought in a small community, 18 units in Arlington in 2023 that we seller financed. This is just as rates were starting to go through the roof. I think we locked in at 6%, 10-year term, 30-year AM. Like, it's fantastic.
Yeah.
The deals that we bought in 2021, we bought on bridge debt, and I probably would never do that again. We just went through a very kind of stressful refi process about a year ago now, and we closed in November, the day before Thanksgiving, thank goodness. And then we just did a recent assumption. So
Mm.
we've run the gamut on debt. I'd much rather deal with directly with agency right now and fixed rate debt. It just helps me sleep better at night.
Yeah, yeah, bridge debt. I haven't done it myself, but I've heard some horror stories out there. And so it's good you
I'll
guys were
give you
able to get
the
out of
short
it.
version on one, man. We had these two deals that we bought, both from the same lender. We had 2-year term and 2 1-year extensions. We got through the 2-year term. They gave us the 1-year extension. Then we went to exercise our next extension because the rate that we had on bridge debt was still less than agency like a year ago. And they said, we'll give you the extension, but we're going to double your rate from like 5.75 to 10.5 or 11.
Wow.
And we did the math, like the deal we would have had to give the asset back. So we pressed on the lender. They agreed in email to come back to it. They said, you know what? Executive leadership has reviewed your file. You're a good paying customer. We'll honor the original rate. Just send us proof of insurance in the appraisal. So celebrate, right? Get the appraisal, get the insurance, send it over. Like, we've changed our minds again.
Oh, jeez.
And despite it, communications in writing, right?
Yeah.
We changed our mind again. We're going to double your rate. You need to get these off term by September 1st for one and December 1st for the other. And here we are, like the middle of July at this point. Like, if we pushed every lever we had at that point, there was no way that we were going to get agency debt in 6 weeks, right? So we ultimately pushed them to do both deals expiring on December 1st. And like I said before, we got the refi done like the day before Thanksgiving. And man,
What?
the full beer never tasted as good as it did that day.
That's funny. Well, it's good you guys were able to get out from under that. I'm sure that was a stressful period. You mentioned assumption. I've never successfully assumed a loan. How did that go?
It was great. It wasn't easy. I think Fannie and Freddie are definitely doing a lot of fraud checks and turning over every rock to make sure that borrowers are liquid and their net worths are sufficient. But we got through it. And we took it over. That property is performing well, between 91 and 94% occupancy every month, like clockwork. Knock on wood. And now we're set up with both Fannie and Freddie. So the next time we make an acquisition, we have experience with them. We have great pay history with them. We know the lender knows us, and we can move a lot more quickly.
Perfect, man. I love it. All right, I just took a peek at the clock. It looks like we have run it down, so it's time to jump into the quick question round. Are you ready?
Let's do it.
All right. Starts with education. It could be any form, could be a book you've read, a conference you've gone to, mentorship program you've been a part of. But I need 2 recommendations, one for general life wisdom and then one for real estate.
I have not learned as much from many other places other than the Tim Ferriss podcast.
Oh, yeah.
Mm. I love that podcast. It's long form, which kind of makes it a little inconvenient, but I can think of quotes. I can think of vitamins. I can think of workout strategies, philosophies, the whole thing. And I just continue to refer back to it. So I would definitely say, for people that are looking to operate and learn to be best in class in anything they do, that's a great resource. What was the second part?
Um, or what was it? General life wisdom and real estate specific. So one, yeah, I will put that in the general life slash
Yeah.
business, and then something for real estate.
I, the Jake and Gino community have been absolutely life changing for me. That first Arlington deal, the first deal we acquired in 2021, we actually made an offer on that deal while at our first Jake and Gino mastermind meeting.
Yeah, that would have been
There was
that's
just
a good thing
something
to
to be
report
said
back
for
to the
being in
group.
that environment. There was people around us that we could ask questions about that we didn't have the answers to. We've had Gino on our podcast. He's talked to my team when I was at Real Page. He's just a great human. And I remember the Saturday that we that mastermind. I asked Gino late in the day, like, "Hey man, do you want to go grab a drink with us?" And he was like, "No, I'm going to church with my family." And he's just got really great values, great human being, and I mean that community's changed my life.
Nice, man. I love it. It's funny you mentioned Tim Ferriss. I read his I think it's called Tools of Titans or something. It was one of those books that was at Costco, and it's my go-to like toilet book because it's like nice. It has those little small sections.
Yeah.
I love it. Anyways, moving us on. This is for your younger self. Let's go back to the Matt who was just getting started. I think it was 2016. Go back to him, look him in the eye, give him one piece of advice moving forward.
Buy everything and don't sell.
That sentiment has been echoed across many episodes on this podcast. We always put it in the same bucket as I wish I got started sooner. Uh, for everybody out there who is in that situation and you haven't pulled the trigger on your first deal, take this to heart. Everybody wishes they got started sooner or they wish they would have kept more properties. So go out there and just get your first deal done. It doesn't matter what it is. It could be a single family, it could be a flip a piece of land, whatever it is, just get it done. And then the dominoes will start to fall 10 years later. You're going to be thankful you got started today. So that's for that. Next question is about your favorite way to find deals. It all starts with getting in contact with the seller and penning that purchase agreement. So give me your favorite way to generate leads and find new deals.
Uh, for me, it's broker relationships, right? I know most of the brokers in the DFW area. I'm on probably text relationship with 75% of the ones that I know. Uh, I don't have the time to do mailers and off market and all that sort of stuff. I know plenty of people that do. I don't. So I rely on the broker network to bring good deals to us.
Nice. Yep. Brokers, it's a tried and true way. For some reason, for the first couple of years of my career, I thought that you could only find good deals off market, and so I was direct mails, cold calling, texting, all that stuff. And then got in contact. As I started to buy deals, I got in contact with brokers, and I realized like it's so much easier just to have a conversation with a broker and find deals that way because they still bring really good deals. So that's my preferred method as well. And that leads us to the next question. This is about lessons learned. Not every deal that we get into goes the way we expect it. In fact, many times things go wrong, but that's when we get to learn a lesson. So, what was a deal that went a little sideways for you guys? And then what was the lesson you pulled from it?
Yeah. Give yourself plenty of room on the deal when you're underwriting.
Mm,
If you're if you're staring at your underwriting tool and you're at a 1.97 equity multiple and you're, scratching your head on a way to get to 2, the best way to do that is lowering the purchase price, right? Insurance has gone through the roof, cost of everything has gone through the roof, taxes have gone through the roof. And I mean, we're not in this bucket, but I know plenty of operators that are. They got very, very aggressive on underwriting. They're at the peak of the market. And then, you had this combination of taxes and insurance, and then, economic occupancy has been on the decline, and it's very hard to recover from that. So be conservative, give yourself plenty of room, and just buy smart. The money's made on the buy side. And then from a CapEx perspective, especially with some of the older assets, like look at the look at the manufacture date on your HVACs and your water heaters. And anything that's over 10 years old, you have to budget for 50% of those to be replaced during your hold period as a rule. And if you don't do that, you're going to be one of those landlords or owners that's got a bunch of vacant units because you can't afford to fix the air conditioning, and then you're facing the occupancy problems that some of these other folks are having right now.
yeah, 100%. I think my biggest lesson learned ever is to have more in your underwriting. Just have more capex set aside when you buy the property because you always have to put more money into the deal than you think you do. That's just,
Right.
even if you like, if you think through the project and you get all the little details down, you still, I guarantee something else is going to happen and you're going to have to put more into it. So, yeah, definitely budgeting more for your projects is a good lesson to learn.
Yeah.
And that
What
leads us.
this kind of inspired me. One thing before we go into the next question. I learned this from a buddy of mine who's built like a $200 million portfolio. Don't ever bet on one-offs, right? If you have a relationship with a property manager, personal relationship, they're going to give you the deal of a lifetime. Don't bet on it, right? Because if they go away and they're giving you 3%, but you go to somebody else at 7%, that kills your deal, right? So underwrite at 7, get 3, and in the event something happens, they drop out, you still budgeted for the 7 and you can go somewhere else. The paving guy that that can give you a great deal, what if, weird things are happening in the world? What if they got to go back to Mexico? What are they got to do some
Yeah,
this? You lose the hookups and end up paying retail price, it could send your entire deal sideways.
yeah, 100%. All right, that leads us to the second to last question. This is about raising capital. It does take money to make money in real estate. So, what is your favorite way to raise capital?
We have been very aggressive on content, right? So we're very active on LinkedIn. We have the podcast. My partner Brian does a lot of kind of motivational stuff online. So we think that getting out into the ether with great content that shows that we're business people and investors, and frankly, dads and husbands, really makes us human and lets people know that we live and breathe the same opportunities that we bring to people.
Perfect. All right, that leads us to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
I'm going to take the last one first. You can always expect a response from me. I will always answer a question, and depending on how good you are, I will, make time for us to get to know one another. It's hard to give time to everybody. I do my best. Um, you can find me anywhere. I'm on Facebook, Matt Buchalski. I'm on LinkedIn, Matt Buchalski. I'm on Instagram as Booch Nasty. An old joke. But you can find me anywhere. Hit me, send me a DM. I'm on them all those platforms every day, and it'll never be more than a day before I respond.
Perfect. I will put that link in the show notes. So if you guys want to reach out to Matt, all you got to do is click a little more in the description. It'll pull down that full description, and in there you can find his links. All right, man. That wraps it up. Thank you very much for hopping on the show.
Awesome. Thanks, Gabe. Hope this is useful for your listeners. Appreciate the opportunity.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.